Chapter 11 is about money. The chapter consists of 4 sections. In social economics, money is regarded as a social relation. It's a social relation of trust and debt, and indeed money enters the economy as debt. We distinguish between fiat money or official money, local money, invented by communities, and virtual money that only exists digitally on the internet. The diagram shows you the exchange rate between the Bitcoin and the US dollar. When we say money is a social relation, we should also say inflation is a social relation, at least in social economic theory. It has different effects on different groups of people. How do we calculate inflation? Well, that looks more difficult than it actually is. First, you take the difference between the new price and the old price. Then you divide that by the old price and multiply it with 100% to get the inflation rate. So if the new price is 150, the old price 135, the difference is 15. You divide that by the old price, 135, and the result is 0.11. You multiply that by 100% to get the inflation percentage, and you get 11%. This diagram shows you the consumer price index of India between 2012 and 2013. As you see, there was quite an increase in inflation in India. But towards the end of the period, inflation was decreasing. In institutional economics, we focus the analysis of money on institutions, in particular the central bank. The central bank has 7 functions in the monetary economy, from the one who issues money, the mint role, to the role of a lender of last resort for commercial banks. The central bank also plays a role in the exchange rate. Countries generally choose between two types of exchange rate: a fixed exchange rate regime, in which the central bank sets the exchange rate and decides when to change it and how much to change it. The other system is a flexible exchange rate regime. It's not the central bank that sets the price, but it's the demand for a currency and a supply for a currency in international currency markets that set the price. But the central bank has an indirect control, because it can influence the price of a currency by buying lots of it, making it more expensive, or selling lots of it, making it cheaper. The money supply increases when commercial banks provide more credit, and the money supply decreases when firms and households pay back their loans more than they take out new loans. So what do we exactly mean when we say money is endogenous in post-Keynesian economics? Well, we say that the supply of money is determined by the demand for money, and the demand for money depends on three motives: transaction motive, you need money to pay your bills; the precautionary motive, you want to keep some money aside on your savings account for a rainy day; and thirdly, the speculative motive. And only for the speculative motive, money depends on the interest rate. And the lower the interest rate, the less people are interested in saving money and the more they want to use it, for example, for investment. So in that case, with low interest rate, we tend to see high money supply, in particular for speculative purposes. This is shown in the diagram on this slide, we see that the money supply for precautionary reasons is a vertical line. Also for transaction reasons, it's a vertical line. You just need a certain quantity, whether the interest rate is high or low. But the demand for money for speculative purposes, that is, to make more money with money, that's a decreasing function of the interest rate. So the lower the interest rate, the more demand for money for speculative purposes. Now let's look at money supply, which, as you will remember, is a response to the demand for money. We picture here two different situations. Either the money supply is vertical and does not depend on the interest rate, or it is horizontal and it's fixed for a certain interest rate. When it is vertical, we call that the situation of non-liquidity or low liquidity, only supply for transaction and precautionary motives. When it is horizontal, we call it high liquidity money, money supply in the case of high liquidity. There's almost unlimited supply of money, and this happens when the economic cycle is on its top during a boom. Now we turn to the post-Keynesian theory of inflation. It's actually very simple and very intuitive. Inflation is caused by increases in cost prices. For example, the oil price, or food prices, or the cost of labor through higher wages. So inflation is not caused by a low interest rate. Cost price increases are related to input prices in a production process, whether it is natural resources or wages or technology. The more expensive that becomes, the higher the cost price and hence the higher the inflation. Let me take you through the example of the bicycle factory of Hero in India. The labor productivity, we use symbol Y, is 6.4 bicycles per worker per day. The sales price of a bicycle is 3,000 rupees. The wage rate is 1,636 rupees. So now we can fill in the equation. The price is a markup, that's a profit rate, over the ratio of the wage rate over the output, the productivity. So fill in 3,000, that's the price, is K prime, that's the markup, we don't know. That multiplied by the wage rate over the productivity, so we get K prime multiplied by 256. Now we can calculate K prime, because that's 3,000 divided by 256 is 11.7. That's the markup. Now I will show you the inflation rate for bicycles in India, taking this example a little bit further. Let's assume that Hero Cycles builds a new factory that's more efficient. So now a worker will not produce 6.4 bicycles per day, but 7 bicycles per day. So that's a change in labor productivity of 9%. Now assume that the labor unions negotiate a new wage, and that new wage is now 2,000 rupees, which means that the wage rate goes up by 22%. Now let's use the formula, the equation of price changes. Remember, a change in the price is then the change in the wage rate minus the productivity. So the change in the price is 22%, minus 9% is 13%. So Hero bikes increased in price by 13%. Do you think this is much? The last slide about the post-Keynesian theory of money discusses monetary policy. Of course, we all like to have a stable financial economy that is transparent and clear. But that's not always the case, unfortunately. Economies move along cycles, certainly in a post-Keynesian perspective. So central banks can stimulate the economy by buying assets from commercial banks and hence providing these commercial banks with the means to lend money out. This will lead to more investment or more consumption in the economy. Another issue is foreign capital flows. For that, the central bank needs to put some controls in place to prevent lots and lots of money suddenly going out of the country or getting into the country, because this leads to instability. In neoclassical economics, money is not endogenous. It's regarded as neutral, meaning that changes in money, in the money supply, have no real effects on the economy. What is important to remember, even if you don't get all the details, is the difference in the explanation of inflation between neoclassical economics and post-Keynesian economics. In post-Keynesian economics, inflation was caused by cost price increases, not in neoclassical economics. Here we have the equation at the bottom of the slide. A change in the prices, that's inflation if the prices go up, is the difference between the change in the money supply and the change in economic growth. It's a bit confusing because Y stands for economic growth here at the macro level and earlier for productivity at the micro level. So inflation actually is caused by too much money supply, according to neoclassical economics. This slide shows you the diagram for the neoclassical theory of money. You see the money supply curve is vertical. That's a control variable for the central bank. The money demand curve is downward sloping, a negative relationship with the interest rate, just like the speculative motive in the demand for money in post-Keynesian theory. So the equilibrium is largely determined by the central bank. If the central bank shifts the money supply curve to the left, the interest rate will increase. And when people are confronted with higher interest rates, They like to save their money because they earn money on their savings account. And they spend less money on consumption and they need less money for investment or speculation. This leads to a trade-off between putting money on a savings account, you do that when the interest rate is high, or buying government bonds or other investments, but government bonds are regarded rather safe. You do that when the interest rate on your savings account is very low. We see also that people buy shares in the stock market, but that is more risky. There's a problem of crowding out because the more money households put in government bonds, the less they have available to invest in firms. Now let's look at neoclassical economics of capital flows. The exchange rate is determined by the trade in goods according to the theory. So when there is net exports, meaning that the country exports more than it imports, there's more demand for its currency. That leads to an appreciation of the value of the currency. And with more imports than exports, it's the reverse. There's a decrease in the demand for the own currency, so that leads to a depreciation. Now what happens when exports and imports don't equal? There may be a trade deficit. There is certainly a trade deficit when imports are more than exports. Well, then the reserve bank or central bank can adjust the reserves. It sells dollars and it buys its own currency, in the case of India, rupees. That helps to keep up the value of the rupee. Alternatively, foreign investors may invest in the country, so they bring foreign currency and they buy local currency. That's another source of stabilizing the currency. Finally, there may be an adjustment of the exchange rate, but that only works when there is a system of fixed exchange rates. It's the central bank, in our example of India, the Reserve Bank of India, that then announces a new level for the exchange rate between rupees and foreign currencies. The last slide in this session discusses balance of payment equilibrium, again from a neoclassical economic perspective. We have an equation. There is equilibrium in the balance of payment when the total sum of the current account, the capital account, and the reserves add up to zero. So there may be a positive current account, meaning more exports than imports, a negative capital account, meaning more capital flowing out than coming in, and there may be reserves to balance this to zero. Now the problem is that international capital flows not only respond to the exchange rate, whether a currency is regarded cheap or expensive, but it also responds to risks and interest rate. Think about the Asian financial crisis in 1997. That was largely determined by accumulating risk and suddenly foreign investors taking all their money away back home.